having looked at the profitability ratios within the performance analysis framework, let us now look at what are known as efficiency ratios. Essentially, these ratios look at how well, how efficiently assets have been utilized. These could be fixed assets, this could be stocks, and this could be accounts receivables or debtors as we call them. So, what we will look at, these are also, as we mentioned here, called as turnover ratios. So, let us look at each of them separately to understand it better. So, when you look at fixed asset turnover ratio, we are talking about what we call as FATR, sales divided by fixed assets. So, we are talking about for every rupee of fixed asset that has been deployed, how much sales are we generating. The higher the level of sales, the number of times you are generating, more efficiently are your assets, fixed assets being utilized. So, if you do a trend analysis over time, if you compare this ratio, you can see if it is a falling trend or a rising trend, and then go on to understand why it has been so. If it is a rising trend, then the reasons could be that capacity utilization have been improved, or productivity measures have been taken by the company, which has improved the asset utilization much better. Worker education has brought that about, etc. There could be a number of such other reasons that you can think about. Similarly, when there is a falling trend, then you can look at why the utilization, if there has fallen, either the market condition that is creating this kind of a situation, is the machinery and other equipment that are being used for production have deteriorated to an extent that even if it working at a fairly high capacity, it's not able to produce production for higher sales, etc. So, this gives us a good idea about when you do over a period of time as to how efficiently your fixed assets are being utilized. The next one we look at is the stocks and debtor turnover ratio. We have split this current assets into stocks at 220 and debtor at 100. So, the stock turnover ratio is nothing but sales divided by the level of stocks, which is in this case 1120 divided by 220, or 5 times approximately the stocks are turned over every year. So, in 365 days, stocks are turned over 5 times. Now, what does it mean in another way? That the inventory days, number of days the stock is held before it is converted into a receivable from a customer, that is a debtor, is 365 divided by 5.09, is still approximately we are holding the stock for 72 days before it is getting converted into a sale or a debtor. So, if we can improve this, if we can make it 60 days or 50 days, that could improve the collection efficiency, because the faster the sales happen, the faster you can expect your debtors to pay. To that extent, the cash inflow into the company will improve. So, improving the stock turnover is another criteria, and a trend analysis over time will tell you is it been increasing or decreasing, and the underlying reasons that needs to be analyzed to find out why increasing trend, what is the right things that the company has been doing, or if it is a decreasing trend, what is happening, what are the wrong things, or is it the market condition, etc. So, this kind of analysis will help us to understand how efficiently the company is utilizing its stocks. As mentioned before, the debtor turnover ratio is nothing but sales by debtors, which is how many times is it collecting in a year the debtors. The other way to look at it is that if it is collecting it in 365 days, 11.2 times, which means on an average every 33 days it is taking for it to realize the cash from its debtors. So, combining it with stock, if they are both stock and the debtor days can be reduced, then the company's efficiency of bringing cash into the company will improve. And remember, when debtors pay, they pay not only your cost but also your profit margin or the profits. So, the profits start flowing into the company, giving you a better cash position. So, improving this along with the fixed asset turnover, the ratio will ensure that your asset utilization improves. Now, I told you before, the return on total assets can be analyzed to see how we can improve. What are the handles to improve the return on total assets? Basically to say, for every rupee of asset, what is the profit, operating profit that I am generating. If you look at this, can be broken down as a part as profit margin, that is PBIT by net sales into net sales by total assets. Since net sales will get cancelled, it essentially the two, when you multiply, give you return on total assets. So, how can you improve profit margin? What the elements you will analyze to understand if profit margin over time has been increasing or decreasing? These the handles that are available to analyze are: look at materials to net sales, look at labor to net sales, look at the factory and other expenses, administration and selling expenses, etc., to understand. So, the elements here can give you an idea how the company has been looking at the managing the profit margin through the various elements and handles available. This is just a sample. There could be other elements also that you can examine. Similarly, in the asset turnover, we have three main elements to see how the total asset efficiency can be increased. The three main asset categories would be how well fixed assets are being utilized. We just saw that. How stocks are being utilized, how quickly debtors are being realized. So, this element also can be looked at as to how they have done over time. A combination of the two essentially tells you what the return on total assets, that is, for every rupee of asset that has been put into the company, what is the profit at the operating level that is being generated. This analysis will give you a good handle on how over time the company has looked at the various elements and where performance improvements have happened and where there have been performance deterioration, and how they have compensated or what is the scope for further improvement also can be analyzed. We now move on to look at the second set of ratios, which is solvency or the long term viability of the company. Basically, what we are looking at is the assessing the level of debt with respect to the total funds that have been deployed in the company, which is essentially total assets, and also look at how much is the interest burden on the company and its ability to pay interest also. So, in the long term, this element of what is the funding structure of the company will determine its long term viability. It also will be determined by its ability to meet interest burden which is there. So, let us look at this one by one to understand it better. The first element is any firm or business has to, when it has to pay interest, it depends upon what is the total amount of borrowing and the actual effective interest rate. Why total amount of borrowing is important? The greater the borrowing in the overall funding structure, that is owner's capital or owner's funds plus long term liability, that is long term borrowing and short term borrowing. When you combine all that, if the borrowing element is larger in that proportion and you have borrowed more money than you have brought in, the owners have brought in, then the company gets into an obligation of paying interest regularly on that borrowing. It also gets an obligation of repaying the loan as per the terms of the agreement. So, the higher the debt in the overall structure of funding in a company, the higher the risk, because while owners' funds need not be repaid, there are no terms attached to the repayment either for the share amount that has been brought in, or for that matter the dividend payment, but there is a fixed obligation as far as borrowings are concerned. That means you make money or not, you make profits or not, you have an obligation to go ahead and pay the interest as well as the repayment of the installments of the borrowings that you have done. So, that brings in the effect of riskiness into the company and therefore the long term viability. The more the debt, the more possibility of a company failing in case the profits and the turnover do not keep up with the expected levels based on which the borrowing was done. So, the interest the company pays is also important, because effective interest rate is something that you have to negotiate, which also is a function of what is the level of interest in the economy. If it is going up, obviously you will have to negotiate within the range in which you have to have. So we can also look at that aspect of company's ability to negotiate a good interest rate. So how we will determine as to what is the ability of the company to pay the interest, that is called as interest cover, which is determined by what is the annual interest obligation with respect to the profit or the operating profit that it is generating. So since this operating profit also has I, PBIT has the I or interest element, it tells us that interest is to be paid out of profit before interest and taxes. So how many times does this operating profit cover the interest amount? The example that we took here says the PBIT is 112, interest is 20, so it is covering approximately 5.6 time, which is a comfortable level. Basically trying to say that if this interest falls another 10, 20 or 30%, the PBIT falls 10, 12, 30%, still there is sufficient cushion for you to pay interest and then have still some profits left out. The problem arises when market conditions deteriorate, your operating profit suddenly fall and your interest obligation, then if it's pretty high, then wipes off all your profit, operational profit, and then the profits below PBIT start suffering a lot. So this angle of how well a company manages its interest obligations is determined by what is known as interest cover, given by PBIT divided by interest.